This is how tens of thousands of Real Vision members get ahead of markets for free. It's called the Daily Briefing Newsletter, and it's an email sent to you every weekday covering the latest moves in markets, from breaking news to the hidden forces that professionals are watching. For example, we'll tell you how institutional traders are positioning against retail tech traders, and why the Japanese bond market impacts your 401k. Plus, you'll never miss an episode of Real Vision's Video Daily Briefing, where you get unbiased, in-depth analysis from people like Jim Bianco, Tony Greer, and Darius Dale after the market's closing bell. It's a great way to stay ahead of the curve, especially if you can't watch the tickers all day. It's free and only takes a few minutes to read, so click the link and sign up now.
What are global money flows telling us? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Gio Chen, Director of Three Keys. Hi, Gio. It's great to see you again.
Hey, Maggie. Good to be back. Good to see you.
Gio joins us from Singapore, so this is a heavy lift for him, and we really appreciate it. But there's no sleep for anyone, it seems like these days, Gio. So we just wrapped up the U.S. session. U.S. stocks tried to bounce back, but the gains were pretty modest, definitely off our highs as we head into the close, and volume pretty anemic. What's your view of the market right now? What kind of macro framework are you operating off of?
Yeah. Back in Q4 last year, the market was on life support. Economy was on life support, and we suddenly got this big adrenaline shot of the China reopening. We saw liquidity surge, and that gave the market a lease of life. But now I think that that adrenaline shot is now fading, and the market is starting to lose momentum. So we've also seen that global liquidity support wane, and I think that's also going to weigh in the market from here.
Yeah, you
So
sent over a chart
yeah,
actually that kind of lays this out really nicely. Hopefully we can pull that up. But uh so how closely do you feel like that tracks? Like, what do we need to understand about the dynamic? And if we're losing that, losing that sort of impetus, what does it mean for risk assets?
yeah, risk assets tend to track global liquidity pretty closely, and this is not just Fed liquidity, but it also includes the BOJ, ECB, PBOC, as well as the Treasury General Account and the reverse repo. So it's a complete view of global liquidity, and you can see it's rolled over, and the market is following it right now, and until this turns, I'm not really going to be very bullish risk assets.
Hmm.
The other thing is that real yields have surged quite a lot over the last few weeks. So at first, this was because the economy was recovering, recession risks were getting priced out, but real yields have gone up a little bit too far, too fast for risk assets to be comfortable.
Yeah. Yeah, we've seen a big adjustment, haven't we? So first of all, I just want to say, if you have any questions for Gio, you know what to do. You can drop them in the chat or tweet us at Real Vision, and we'll get to as many as we can. So first of all, let's stick with global liquidity for just one moment. Is this so the lift in liquidity that we saw and the help that it provided, support that it provided, or adrenaline to risk assets, is it gone and not coming back because we're still in a tightening cycle? How, or are we going to see ebbs and flows, and will risk assets move with that?
I do think we will see ebbs and flows. It's possible that China may try to continue to stimulate their economy. It's possible that the BOJ might end up buying more bonds. So it's hard to see what's going to happen out of China and Japan. But I think for the Fed, yes, we have about 400 billion worth of liquidity in the Treasury General Account that could be spent. But once that's spent, the Fed the Treasury is going to have to pull liquidity out of the system again, and this could happen by Q2, Q3.
Mm. Do you think that how concerned are you, or how closely are you watching the BOJ?
I'm watching them pretty closely because the BOJ policy and Japanese institutions, they are one of the big pillars of the global bond market. So if they normalize and if their yield cap gets widened, then basically that's going to pull out the floor from Japanese institutions buying global bonds, and that's just going to make the downside for global bonds a lot scarier.
Yeah. Do you think the sense when people are starting to talk to it, and I'm not sure it's front and center for everyone because people are sort of looking out to June, so maybe a little further down the down the year than people are focused right now when we're getting, we're kind of from data read to data read and so focused on inflation. Do you think that investors in the West have it right? There is this sense that there's a change in officials. This is going to be it. This is going to mean that that it is going to make a change to yield curve control. And then the question is, can they control it? But there's a sense it's going to change. Do you think that is overstated? Could investors be wrong about that?
You mean wrong about what
that they
BOJ is
extend
do?
the band? Yeah, that they kind of start to change their policy toward yield curve control.
Yeah. I think they will be forced to. So similar to what the Fed being very determined to keep rates low back in 2021, but then the data came and inflation wages were a lot higher than expected, and they were well behind the curve, and they were forced to move. So I think something is going to happen to the BOJ in a similar vein, where the wage data, the inflation data is going to be a lot hotter than they expect. They're expecting inflation to go down. They're expecting the global economy to slow down, and take Japanese inflation down with it. But it's clear that's not happening. China reopening has extended the inflation runway for Japan as well, so that we may see a higher peak than what we normally otherwise would have for Japan.
That's really interesting. So it's interesting that you're looking at global liquidity flows. I had the chance to sit down with Mike Green of Simplify for our podcast, My Life in Four Trades. And first of all, he was also looking at those global liquidity concerns, the temporary nature of the liquidity injections that you just mentioned. But he's also worried about some other market conditions. Let's have a listen to that clip, and then we'll talk on the other side.
In this situation, like what I'm just constantly forced to do is I go back to the same thing I did with the home builders. Did anything change? Am I seeing the behavior differently? I'm looking at flows right now, and I'm seeing money continue to come into passive vehicles and leave active vehicles. Does that mean that the things that I'm worried about or the positions that I'm focused on happen exactly the same way as they did in 1929? No, right? Not at all. But the kindling is on the fire, right? And now it's a question of, does somebody throw gasoline in a match? We don't know, right? The gasoline in the match for the 𝗗𝗓 was the Fed in an unanticipated way changing the capital requirements for shortfall trades, setting off a scramble. I have to believe that the Federal Reserve's actions that we're going through now, the unprecedented hiking cycle, the intensity with which they're pursuing inflation, that's going to create conditions under which somebody gets stretched enough that they go postal, right? And I want to be positioned for that opportunity.
And it's funny because just before we went to that, Oliver in one of the chats put 1929, when the free bread. And Mike is kind of venturing back to that, referring back to that time period, which is, I know, scares all of us. But do you worry, first of all, if you want to see that whole interview, it's fantastic. I encourage you to have a listen to it. A lot of parallels that Mike sees between things he's gone through before and setups he sees kind of happening again. I mean, that old phrase, history repeats itself. So fantastic sort of lesson for everyone. the full interview is on the website. Just hit the QR code and find out how you can become part of our community if you're not already. Gio, do you, first of all, what are your thoughts on that? Do you worry? He says someone going postal, but do you worry about a failure that would be systemic in some way?
Yeah, absolutely. And I think, with regards to 1929, I think the kindling is there, except this time it's really in the government bond market, because we've had all these passive flows going into 60-40 strategies, and 60-40 is probably not going to work for a long time, just because inflation volatility is going to be here with us for a while. And meanwhile, you have a lot of pillars of support for the treasury bond market falling away, and there's still a lot of downside because there's still very little term premium out there in the market. Investors are still not getting paid to take the risk that they're taking in long dated bonds, and we saw a glimpse of this in the LDI crisis in the UK gilt market, and I just think that's a prelude for what's going to be happening over the next coming years. So, I'm not saying that bonds are going to crash today, but there are going to be some volatility events, just like we saw in gilts over coming years.
Which is going to create a problem for central banks. Well, it's going to be
Absolutely.
It's going to create a problem beyond central banks. That is an understatement. But what walk us through what would be the catalyst, and what does that mean in real terms? I mean, obviously we'll see yields go higher.
Yeah. Well, if you look at what happened with UK gilts, it was basically the government and central bank saying we're going to stop being responsible. We're going to stop spending responsibly. And the market basically called them out on it. So I think, what could trigger that? Same thing happening in the treasury market. It could be a combination of, accelerated spending by the treasury, whether it's to fund, military war in Ukraine, the economy, fighting inflation, and then maybe the markets not really believing the Fed anymore, and believing that the Fed is determined in getting inflation back down. So then, in a case like that, where the Fed loses credibility, the government loses credibility, you could see 30-year yields really shoot up.
Yeah, I think this is where the BOJ becomes worrying for people as well. That's another one of those events out there that we had George asking, what about the BOJ problems, the yen, the dollar yen effect on the global economy? If they are not able to keep control, even if they're changing it, if they lose control of that yield curve, I mean, that could have huge implications.
Yeah, I do think so. I think the BOJ, I don't think they're going to pull the rug out completely from the JGB bond market. I do think that they'll have to somehow, manage that move when it does happen. But it'll be disruptive for sure, and especially to global bond markets, not just the JGB market.
Yeah, I guess the question is, so you think they can handle it, that they will be able to at least maintain it in some orderly fashion?
Yeah, I can see a scenario where they try to smooth the move, and yeah, they'll have to be forced to buy a lot of bonds, but they've already been doing that.
Yeah. The reason we keep talking about this, and we will, even if you're somebody who doesn't have any international exposure, and the reason some of our regulars are asking about it is because, as Gio just pointed out, it could have huge implications for rates everywhere in the economy, which is definitely something to pay attention to. Gio, I know you sent over another chart, and by the way, we as you mentioned earlier, we have seen big moves in U.S. rates on those yields for U.S. Treasuries. when everyone started rethinking the Fed after that batch of stronger than expected data. You sent over a chart of the SPX versus the MOVE index. Why are you watching this? What are we looking at here?
Yeah. So the MOVE index is basically an index of treasury bond volatility. And you could see that it was starting to trend lower, over the turn of this year, and that was based on the Fed kind of honing in on terminal rate being a little bit under 5. The market had a line of sight on when the Fed was going to stop hiking, and then suddenly, all within the space of a few weeks, we had some really hot data, NFP, retail sales, and CPI and PCE last Friday, and suddenly expectations of terminal rate are shooting back up, and now the market doesn't really know when the Fed is going to stop hiking, and this has the markets really worried. So, yeah.
Yeah, and we see that. So, it's interesting. This week we have a big jobs report at the end of the week, which I think is going to be very important. We did the economic data. It's hard to get any clarity. We had durable goods fall today. That's a bit backward looking, but pending home sales rose. They're still down sharply year over year, but that monthly number did beat expectations. But there seems to be so much sort of uncertainty and seasonal effects. No one's really sure, what kind of read. Do you think that Fed policy is just not working, or have we just not seen the impact of all of the rate hikes to date?
I do think it's working. I do think that the broader trend is that the economy is weakening, and that this most recent strength has been partly due to liquidity and the China reopening. So I think that we are going to see perhaps one more month of strong data, maybe two, but then that's going to roll over. So I am expecting the hot data to continue into March, and for yields to start to continue grinding higher. But I don't think it's sustainable.
So you see an adjustment in the market, in the treasury market, once we start to get that slower data in, because right now they're really ramped up expectations for what the Fed is going to do. Do you think they've overdone it?
I don't think they've overdone it yet. I think it's still possible that the Fed could even hike 50 in March if we have one or two, pretty hot data prints, NFP, inflation. It's, I think it's a real risk that the Fed terminal rate is going to go above 5.6. So I don't think we're there yet. And as a global macro trader, my focus is really on the first derivative right now, because that's been a clearest trade. The global liquidity surge, the China reopening, flowing into economic data, pushing inflation higher and resulting in higher yields. The rollover in risk and the higher dollar is really just the second derivative effect, and the market response there hasn't been as strong as just being short the front end of the interest rate market.
We have a question from Paul. I don't know if you have all this at your fingertips, but I don't know if for those of you who are not members, Geo did a fantastic we have a show called Three Big Ideas, and he did one back in December, and Paul was asking for an update on that. So back then you were looking at France USA 5-30-year US Treasury steepener, long gold, and long yen, JPY USD. Any update on those trades and how you are thinking about those areas now?
Yeah. So in my blog, Finezza Macro, I track those trades and post the performance on the blog, and I also update on what I'm doing with those trades. So the 5-30-year steepener, I decided that it was still too early to play for that move. So I got out of that position at a small profit. Dollar yen, gold are in the money, and with dollar yen, I've still in the money, but given back some profits on that because the surge in the dollar.
Mm.
I still think that dollar yen this year is going to be is the downtrend will resume, but I do think that's after we see the economic data roll over. So I'm still in that trade. Gold, I took profit and got back in about 5% lower.
Oh, it's interesting. So do you still feel like gold is going to move to the upside? Because that was a lot of that was a big favorite at the turn of the year. And then, of course, we saw the downdraft. But is that just responding to that global liquidity and the rise in risk? How are you thinking about gold?
Yeah, gold had a really strong upward trend, and it got very, very overbought.
Mm.
So part of the snapback was because it was overbought, but also because um, expectations for the terminal rate have shot up, and real yields have been going back up. So that's been weighing on gold. Um, I do think that when the market kind of finds a ceiling on real yields and a ceiling on Fed terminal rates, gold is going to shoot back up again, especially now that a lot of late or weak longs have been cleared out. And in the long run, and I'm talking about time horizon of 1 year or more, we're seeing the Fed the Treasury budget deficit. It's projected to be at a deficit for the foreseeable future. And these are estimates from the CBO. The government is saying that we're going to be borrowing and spending a lot more than what we're taking in for the foreseeable future, and their estimates even widened. So you have to wonder in a environment of volatile inflation, how sustainable is this?
Yeah. Yeah, fantastic question. By the way, thank you, Trillion X. Non-farm payrolls is not this Friday. It's the following Friday. Usually it's the first Friday of the month, but we have ISM this Friday. So non-farm payroll is going to be March 10th. So we've got 2 weeks to stress out about it. Thank you very much. We have a great question from Oliver, who's asking, what is a risk that is not somewhat factored into the market already? We have everything from World War III to recession to depression on the table. I mean, there are a lot of concerns out there. Is there something you think that investors are not paying as much attention to as they should, Gio?
I do think that tension between U.S. and China is always going to be there in the background, and the trend is definitely towards bifurcation of investment capital, and I think that there's a real risk that the U.S. imposes regulations that prevent a lot of investors from investing in China. And I don't know if this is going to be in the public markets and in ETFs or just private markets or certain industries, but I do think it's coming. And that's just going to weigh on the Asian markets.
So you think that's interesting because someone asked, do you like the Singapore Straits Times equity index at these level? What about other Asian equity markets? Anything that looks good to you?
Japan is interesting to me, mainly because it's historically been cheap, and I think that I do think that Asia and Japan can weather this economic weakness this year, perhaps better than the U.S. And especially in the financials, where the banks are benefiting a lot from speculation of BOJ normalization.
There was connected to the China reopening, there was this idea that you would also see sort of a halo around some of the Asian markets that benefit, whether it's tourism, whether it's trade, that reopening would spur a lot of economic activity in the region. Are we seeing that? What is the reopening China's reopening living up to everyone's expectations?
Yeah, the FXI China ETF is down 15% from the high right now. So it's kind of a barometer of how much the China reopening is feeding into the markets. It seems like the impulse has waned a bit, and you do see the central bank trying to inject liquidity, trying to stimulate the economy. But I think the jury is still out on how durable and how strong this reopening is going to be, especially with regard to the financial markets.
Yeah. Somebody earlier, I can't find it now, but was talking about some of the Chinese stocks. Do you think, based on that threat of deepening tension between the US and China and the possibility of some sort of, I don't know if you want to call it a sanction, but some sort of action, that would you be investing in China at all right now, given that?
I think it's just really risky. And after this rally, I think a lot of the low-hanging fruit that was there last year when everything was just ridiculously cheap, I think things aren't as cheap anymore. And it's clear that you have the China reopening impulse. Not sure if that's going to last, for I guess 6 months to a year, which is the typical time horizon for a lot of investors. Coming out on the other side, you still have the real estate debt bubble that is still imploding. That's a problem that's not going to go away anytime soon. So geopolitics, China debt bubble, these things still concern me, and that's why I'm not hugely bullish on China equities.
Mm. Is there any area that you do feel bullish on? Because it seems fraught with
Yeah,
worry, and a lot of people that we've had on, as our viewers will attest to, and I think some of them just that's the only thing that's been working for them. Everyone's saying cash, because you're getting paid to sit in cash when the outlook's so uncertain without too much risk. What about you? How are you thinking about that?
yeah. I mean, cash is generating a great return, and I personally um, have allocated a lot to T-bills, and it's just a great way of getting yield while sitting in dry powder. I I think that there's a lot of debate on whether we're going to have a soft landing or a hard landing. I'm not focusing on that because I think we're still climbing up the hill of the Fed hiking cycle. I don't know what's on the other side, but I'm not going to focus on coming down the other side uh, until we get to the top. So if we get to the top and it looks like we're going to see a soft landing, then I'll be starting to allocate to equities again. And but until I get that view, I think it's still too early to say.
A lot of people were sort of surprised to see those tech names when equities did get a bid at the beginning of the year. They were surprised. They thought it was going to be value. They thought it was going to look different, and yet you saw some of those tech names.
Yeah.
And Jim Bianco was pointing out Friday, very concentrated. It wasn't very many of them, but you saw ARK have a fantastic run. I mean, people were scratching their heads at that. Does it, if once we are in a position where you're think about going back into equities, is it going to look different than it did, or is that going to be continue to be where the money goes when you sort of see the green flag, and people are ready to go back into risk?
Yeah, that was very surprising, I have to say, and because the popular favorites of what to be long if the market recovers, as you said, value, energy, um, emerging markets. They did well, but they didn't go up as much as the the hated, most shorted stocks, um, low or negative profit companies. And the question is, when we come out, when we bottom out, um, what's going to go up the most, I really don't know. I think a lot of that surge was due to liquidity, especially coming out of Asia, and that helped a lot of the crypto names. And it was also a function of a lot of those names just being so beaten down, and those downtrends being so oversold.
Yeah. It's such a difficult environment, as we've had so many that come on and say, do you think the Fed's framework is broken? I mean, obviously they're trying to engineer this. They're trying to get inflation under control. Do you think the framework they're operating on even works anymore?
I don't think they have a framework, so the answer is no. I think they're like they're flying a plane where the instruments don't work anymore. They previously relied on the instruments to tell them where they were going to land, but the instruments don't work anymore, and now they're just trying to use their own vision through a field of fog. And when this happens, sometimes you might see things too late, and so they might not see where they're supposed to land until it's too late, and that's the kind of thing that could potentially cause a hard landing later this year. So we'll see what happens.
Yeah, well put. So if I think about everything that you were just talking about, that right there sums it up. That they don't have a framework. Their possibility for a policy error is high. Cash is also something you like as you're trying to bide time to figure out, when they stop climbing up the hill of policy, when they do get a handle on things. You think golds will have a bounce. You're concerned. You share some of Mike Green's concerns about what will happen, or sort of risk to the market, especially when we're looking at government bond markets, and that sort of rally we saw at the beginning of the year was really more to do with global liquidity than any kind of fundamental conviction, which makes risk assets pretty vulnerable right now.
Hmm.
Is that a fair summary?
Yeah, pretty much. Yeah, pretty much.
How concerned are you on the downside for risk assets? Are we just going to grind along the bottom here, or do you see a real concern that we could go back and test those lows?
I think it's going to be a grind, because the market is not super long. Asset managers, hedge funds have not piled into equities. Neither have CTAs. I think a lot of the surge in January and February has been due to retail. So a lot of that liquidity got pumped into retail, and so I've seen some data where the flows from retail have just surged to above the highs of last year on the two big rallies that we had last year. And so I think that's where flows could unwind. But once those unwind, there's not going to be a lot of people left to sell. So I do think, I don't know if we're necessarily going to see the lows from last year get taken out. I just think we're going to be in a period of moderate weakness.
That's a great point. Gio, it's always fantastic to catch up with you. Thank you so much for bearing with the time difference and joining us again. Great to get your view, and really anyone who's sort of like to get the view from all around the world, to see if there's any differences. So great to catch up with you.
Yes, good to catch up with you too.
Thank you so much. And thanks to all of you once again for the great questions. You guys are amazing. We will be back same time tomorrow with Tony Greer. Come armed with some other good ones. We'll see you then. In the meantime, take care and good luck out there.